Firms need to be able to assess the relative merits of competing potential locations for market growth and production. The conditions that prompt trade include push factors, pull factors, offshoring and outsourcing, extending the product life cycle, and raising capacity utilization. Push factors are the reasons businesses move production or sales abroad, and the different push factors are saturated markets and competition. A saturated market is one where demand for a product has been fully met, prompting trade as firms seek new markets for growth. Competition is the rivalry between businesses, prompting trade as firms look overseas to gain an advantage or reduce costs. Pull factors are the attractions of trading internationally, and the different pull factors are economies of scale and risk spreading. Economies of scale occur when increased production reduces average costs, prompting trade as firms expand to new markets to achieve these savings. Risk spreading is dividing business activities across different markets, prompting trade by reducing reliance on one market. Offshoring is moving business operations to another country to reduce costs or access new resources. Offshoring prompts trade by increasing international production and supply chain links between countries. Outsourcing is contracting another company to perform tasks or produce goods that were previously done internally. Outsourcing prompts trade by encouraging international cooperation and the movement of goods and services across borders. A product life cycle is extended by adapting or marketing the product to delay decline and maintain sales. A product life cycle is extended by selling in multiple markets where demand remains strong as other markets mature. Selling in multiple markets prompts trade as firms seek new regions to continue generating revenue from established products. Capacity utilization is the percentage of a firm's productive potential that is actually used. Capacity utilization is raised by increasing output or expanding into new markets to use resources more efficiently. Raising capacity utilization prompts trade as firms look abroad to sell surplus output and maximize production efficiency. A business would expand into a different economy to access new customers, reduce costs, increase profits, or spread risks across markets. The factors influencing expansion into a market are levels and growth of disposable income, ease of doing business, infrastructure, political stability, and exchange rate. Levels and growth of disposable income refer to the amount of money consumers have to spend after taxes, influencing expansion as higher incomes increase demand for goods and services. Ease of doing business measures how simple it is to start and operate a business, influencing expansion as firms prefer markets with fewer regulations and lower barriers. Infrastructure refers to transport, communication, and energy systems, influencing expansion as strong infrastructure supports efficient production and distribution. Political stability means consistent governance and low risk of unrest, influencing expansion as it creates a safe and predictable business environment. Exchange rate refers to the value of one currency against another, influencing expansion as favorable rates can make exports more competitive or reduce costs when investing abroad. The factors influencing the location of production sites are costs of production, skills and availability of the labor force, infrastructure, location in a trade bloc, government incentives, ease of doing business, political stability, natural resources, and likely return on investment. Costs of production are the total expenses of creating goods or services, influencing location as firms choose sites where costs like labor and materials are lower. Skills and availability of the labor force refer to the abilities and number of workers, influencing location as firms need access to skilled and sufficient labor to operate effectively. Infrastructure affects production site location because efficient transport, communication, and utilities reduce delays and costs. Location in a trade bloc means being part of a group of countries with reduced trade barriers, influencing production location as firms can access wider markets with lower tariffs. Government incentives are financial or regulatory benefits offered to attract investment, influencing location as they reduce costs or increase profitability. Ease of doing business affects production site choice as firms prefer areas with clear laws, efficient systems, and supportive regulations. Political stability influences location because businesses prefer to operate in countries with reliable governments and low risks of conflict or policy changes. Natural resources affect production site location as firms often locate near essential raw materials to reduce transport costs and ensure supply. Likely return on investment is the expected profit compared with the cost of investment, influencing location as firms choose sites that promise higher long-term gains. Thank you for watching this video on economic factors in business expansion. I'll see you in the next one.